Welcome back to the deep dive. Today we are taking a really close look at the credit services sector. We've kind of filtered things down to, well, a fascinating trio of high volume stocks, all trading over $10. They really represent the breadth of the fintech landscape today: SoFi Technologies, PayPal, and Upstart Holdings. Our mission here is simple: move beyond just the numbers on a spreadsheet. We're going to try and translate the raw data, the fundamentals, the technicals from our screener on these three into, sharp, actionable insights. Think of it like a high-level journalistic report. We want to give you, the listener, a shortcut to understanding why these companies are priced the way they are.
And that why is, well, it's absolutely crucial in this sector. It really is.
Yeah.
These three, I mean, they represent vastly different ways to invest. You've got established giants like PayPal trying complex pivots. Then these explosive digital banks like SoFi and highly volatile AI players like Upstart. The difference in their business models, their volatility, it's huge. And just for absolute clarity, remember, this analysis we're doing, it's purely for educational illustrative purposes. Think of it as fun with paper money math, definitely not investment advice.
Okay, let's unpack this trio of stocks then. We'll kick things off with SoFi Technologies, the hyper-growth digital banking contender. Yeah, SoFi recently closed around, $25.97. It's clearly valued for speed. Looking at the financials, that trailing price-to-earnings ratio, the PE, it's way up there at 52.38. A number that high, well, it might scare off some traditional value folks. Right?
Yeah, it's steep. But what's fascinating here is how the market seems to justify that PE. It really reflects a strong belief, I mean really strong, in SoFi's explosive growth potential. And you see that belief measured in the PEG ratio, which is 2.04. The PEG factors in expected growth against that PE. So essentially, the market thinks the speed of SoFi's expansion justifies that high price tag.
And the underlying numbers, they seem to back up that rapid expansion story. Sales growth, quarter over quarter, pretty strong at 31.24%. But the number that really jumps out, I think, is the forecast for next year. Earnings per share, EPS, expected to grow significantly by an astounding 78.81%.
Wow, yeah. And on top of that, their financial health looks incredibly robust. They've got high liquidity. Look at the quick ratio and current ratio, both 4.52. That means they have, massive cash reserves relative to their short-term debts.
Which is crucial, right?
It gives them room to handle bumps in the road or fund growth without needing to borrow heavily.
Okay, shifting to the technical side. SoFi's performance, been nothing short of remarkable lately. Long-term momentum, hugely positive. The stock's up over 230% in the last year alone, although if you look closely, there's maybe a slight short-term cooling off. The SMA 20 is a bit negative, but it's still way, way above its 52-week low of $7.57.
Right, a little pullback. But the technicals also confirm this ride comes with risk. The beta is 1.94. That's high.
Very high. What does that mean exactly?
It means the stock tends to move almost twice as much as the overall market. So if the S&P 500 goes up 1%, SFI tends to jump almost 2%. But that volatility cuts both ways, of course.
Okay, so big swings possible.
Exactly. Let's maybe illustrate that upside volatility. Let's do a quick historical what if. Say we use that 52-week low, $7.57, as a theoretical buy trigger in the past. A $5,000 paper investment back then, that would buy you approximately 660 shares.
Okay, 660 shares for $5.
Now, fast forward to the recent close of $25.97. That paper investment, it would be worth around $17,140. So that's a theoretical paper profit of over $12,000.
Wow.
Yeah. It perfectly shows the kind of dramatic gains you can see with the high beta growth stock, if it delivers on its early promise.
And the recent news flow seems to support this idea that SoFi is building out its ecosystem. We've seen them expanding options, trading for investors, digging deeper into their Galileo platform.
Yeah, the Galileo platform is key.
And some analysts are even saying SoFi could be one of the biggest U.S. banks in 10 years. Ambitious stuff. All right, so if SoFi is the high-octane digital future, our next company, PayPal, offers a really stark contrast, maturity maybe, and this intriguing value proposition the market isn't quite sold on yet. PYPL closed near $68.93, much bigger company, market cap around $66 billion. Okay, here's where it gets really interesting, because the fundamentals, the valuation, it suggests significant value, but the stock's performance tells a completely different story. Deep market skepticism, maybe. PYPL trades at a relatively low PE of 14.76, and the forward PE is even lower, 11.84.
Exactly. This is an established, highly profitable giant. Look at the metrics. Profit margin, 14.49%. Return on equity, ROE, an impressive 22.92%.
So why so cheap then?
That's the million-dollar question, isn't it? Why is such a profitable company trading at such a low multiple?
What's the thinking there?
Well, the skepticism seems to center on a few things. Competitive threats, definitely Apple Pay, others, and maybe slow monetization of their huge user base. Investors seem worried about margins getting squeezed.
Ah, margin compression, right.
So that low PE, it reflects concern that future growth estimated at, what, 12.45% over the next 5 years, just won't generate the same quality of earnings it used to.
And the technicals, the charts, they confirm this negative feeling has stuck around. The stock's really underperformed, down over 19% just this year. And wow, 63% down over the last 5 years.
Ouch.
Yeah. While the 20-day average shows a tiny recent uptick, the long-term trend is still negative. It's trading below its key 200-day moving average by about 5.70%.
And that break below the 200-day, that's a classic technical sell trigger for many traders.
Right, signals more potential downside.
Often, yeah. It suggests the long-term downward trend might continue. We could use this for another paper trade illustration. Let's imagine a paper short position was opened when the stock broke convincingly below that 200-day average. Let's say around $73.10.
Okay, so betting against the stock.
Theoretically, yes. If you initiated a $5,000 paper short at $73.10, that's about 68 shares. And then you covered it, bought it back, at the recent close of $68.93. The price drop means the short position makes money. The difference would be a theoretical paper profit of about $284.
I see.
It just shows how traders might try to capitalize on that sustained technical weakness using signals like that 200-day breakdown.
But operationally, PayPal isn't just sitting there, right? They're trying to change the story, making aggressive strategic moves, signaling a pivot towards future commerce. They did that massive $7 billion sale of their U.S. buy now, pay later receivables. Cleans up the books a bit.
Streamlines things, yeah.
And importantly, they seem to be doubling down on tech, partnering with Google on AI stuff, expanding their PYUSD stablecoin, integrating crypto more. Okay, finally, let's turn to Upstart Holdings, UPST. Recently trading around $52.88, market cap just over $5 billion. So the smallest of the three, and definitely the most volatile.
Oh, yeah. If we connect this to the bigger picture, Upstart is the clearest example here of the high-risk, high-reward model. They're betting everything, basically, on their proprietary AI for loan underwriting, not on immediate earnings. Their trailing earnings are negative, so no trailing PE. But the forward PE is 21.76, suggesting analysts think profitability is coming soonish.
This stock presents a really fascinating paradox looking at its financials. Sales growth quarter over quarter just rocketed up 101.59%. That's huge. And their gross margin is almost perfect, 97.38%. But wait a minute, how can the gross margin be that high, yet they're still unprofitable? Isn't that kind of weird? Maybe a red flag.
That's the core tension with UPST, absolutely. The negative profit margin, the negative ROE, they reflect massive scaling costs right now. That super high gross margin. It tells you their core AI product, the tech itself for underwriting, is incredibly efficient once a loan is made.
Okay.
The unprofitability isn't really about the tech not working. It's about the cost of scaling the whole platform, proving the AI model to the market, acquiring customers, all that stuff during this intense growth phase. And they're heavily leveraged too. High debt to equity at 2.13. Big bet.
And this high-risk bet, it translates directly into the technicals, doesn't it? That beta is extreme, 2.28. Confirms it's a wild ride.
Absolutely.
The stock suffered big recent pullbacks, down almost 18% in the last month alone. And all the key moving averages, the SMA 50, SMA 200, they're pointing down, suggest continued technical weakness.
But these kinds of technical breakdowns, well, they create the exact situations that contrarian traders look for. We see two huge related signals here, suggesting a potential reversal or at least a bounce. First, the short float. It's extremely high at 26.30%.
Meaning lots of people are betting against it.
A huge percentage of the available shares are being shorted, yes. The so-called smart money is heavily betting against them.
Okay, what's the second signal?
The Relative Strength Index, the RSI. It's sitting at 32.16. That's creeping really close to the classic oversold territory, which is usually below 30.
Oversold. So maybe it's gone down too far, too fast.
Potentially. And when you get heavily shorted stock hitting oversold levels, the potential for a massive rally, what they call a short squeeze, is enormous, even if it's just temporary.
Interesting dynamic. Okay, let's run a paper money scenario again. A potential contrarian buy, maybe, based on that low RSI and the high short interest. Let's assume a paper buy at the recent price, $52.88. And if we use the average analyst target price of $77.57 as a theoretical profit target, that suggests some serious upside potential.
Right. So with a theoretical $5,000 paper purchase at $52.88, you'd pick up approximately 95 shares. If, and it's a big if, the stock were to hit that average analyst target price of $77.57, the theoretical paper profit would be around $2,333.
Decent potential gains.
Yeah, but that high potential reward is absolutely tied to the huge volatility and the inherent risk of this pure play AI model actually working out long term.
And the recent news just confirms that extreme volatility. UPST lost, what, 31% in September alone due to market pressures? And even though their last earnings report, Q2, actually beat estimates pretty significantly.
Yeah, good surprises on EPS and sales.
The market got spooked because they were raising money through convertible notes. Dilution fears, maybe?
Exactly. Their success really hinges entirely on the market, eventually buying into their AI underwriting edge. It's all about validating that core tech. Hashtag outro.
Okay, so we've looked at three really distinct business models, all operating under this credit services umbrella. We've got SoFi, high growth, high PE, backed by aggressive forward estimates, clear recent momentum. Then there's PayPal, the mature giant, trying a strategic transition, offering that low PE value play, but facing market skepticism about its pivot to crypto and AI. And finally, UPST, the high-octane, pure AI innovator, defined by extreme volatility, explosive sales growth, but currently unprofitable because of those scaling costs.
So what does this all mean for you, the listener? Well, we basically see three distinct strategies playing out in this space: pure digital banking growth, a major platform pivot, and pure AI innovation. Understanding why their valuation metrics are so different is crucial, like comparing SoFi's high trailing PE against its huge expected EPS growth next year. That helps you understand the market's bullish story there. Whereas PYPL's low PE reflects caution, maybe skepticism about whether they could really pull off this complex, long-term pivot against tough competition.
That really makes the future dynamics fascinating, doesn't it? The integration of AI and, interestingly, stable coins seems to be a common thread they're all exploring for future growth.
It does seem to be a key theme emerging.
So the ultimate question for you to think about is this: will PayPal's strategic pivot and its, solid underlying profitability eventually stabilize its performance and let it reassert dominance? Or will the explosive, even if volatile growth stories of these newer pure play innovators like SoFi and UPST eventually just restructure the whole financial technology sector? That's definitely something to keep an eye on.